Hello everyone, welcome to the last part of chapter number 3. In this video we are going to cover the remaining topics of chapter number 3. So let's start from where we have left. If you come to the page number 28 of your lecture notes, we have got the topic of rates of interest and return, things that is most important when we discuss about debt instruments. Let's see what it has to say. Interest rates on financial assets are influenced by the risk of the assets, the duration of the lending, and their maturity. The pattern of interest is a different thing from the general level of interest rate. Following factors influence the pattern of interest rates. Now, it's a basic thing of financial management that higher risk companies, that is companies that have got high risk, in terms of it's like they are already in a lot of debt, and it's likely that the investment could go down the drain if you do the investment. So these sort of companies, obviously when we invest in these sort of companies, we expect a higher return because we are facing the additional risk of investing in that company. I could have used my funds to invest in a safe company, but I'm investing in that company, so I expect a more bigger return than the less risky company. That's the relationship between the risk and return. Now, the pattern of interest rate is a different thing from general level of interest rate. Let's look at that. Risk. There's a trade-off between risk and return. Higher risk borrowers must pay higher yields. As I've just told you, if a company is highly risky, it already has a lot of debt capital involved, which means it has to pay those debt holders as well, and then also to the me who is investing in that company. So I expect a higher return from them. Then we've got need to make profit on re-lending. Financial intermediaries make their profit from re-lending at a higher rate of interest than the cost of their borrowing. When we talk about financial intermediary, example, a bank, when you go to a bank, it basically has to obtain funds from people and it offers them an interest rate. Now it has to pay the interest rate to them as well as earn a profit on giving you the services of being a loan provider. So they charge additional interest above the rate which is offered to the borrowers. The minimum rate is set by the central banks, for example 5 to 8%. The central bank's interest rates vary from country to country, and they give the loan to the companies at a rate above them. So that for example, if a 6% is set by central bank, then they will give a loan at 10%. 4% is the additional, or you can say the profit which the bank earns on providing the loan. Then we've got duration of the lending. Longer dated assets will earn a higher yield than smaller short dated assets. If I'm the debt holder of any company, it means that I have my funds locked in that debt which I have provided. So the longer the time they take to repay the principal and the interest, the more the return I expect from them, since I could have used that fund for a better opportunity during that time if it arises. Size of the loan of the deposit. Administrative cost saving helps to allow lower rate of interest to be charged by the bank on larger time deposits. If they are, it's basically relevant to the term deposit. Now here what happens is that banks, especially during the ending of the year, what they do actually, they offer special arrangements to the big fund holders, from which they expect that they can invest in their bank. What they actually do is that if they deposit a fixed term deposit in their bank, they will offer them a very lucrative and a handsome return on those deposits, provided that the sum is in millions. They require the big deposit to be made to the banks so that they can earn from that as well. So big financial institutions, normally what they do is during the year, as the year end comes closer, they and the bank starts offering them these sorts of arrangement. They avail the opportunities and deposit the fund for 1 or 2 months with a hefty and lucrative returns. So that's the size of the loan. The bigger the loan, the least cost is incurred by the bank on managing it, because irrespective of whether the loan is big or small, it has to follow the same regulation. It has to keep the same level of security to the funds. It has to keep them protected. So the bigger funds mean there will be a cost saving, and which can be transferred to the provider of finance as well in the form of benefit. Then we have got different types of financial assets. They attract different types of returns. Normally debt instruments, especially the convertible instruments, are higher yield because they give the debt holder a chance to convert their debt into shares on a predetermined price. Then we have a London interbank offer rate, or LIBOR. It's a thing which is important when computing the debt instruments. That is the rate of interest at which banks borrow from each other in London interbank market, set by the central banks. And the borrowing between the banks is done above those rates. The minimum threshold is set by the central bank. Then we've got the rates of interest paid on government borrowings, provided a benchmark. Clearing banks might set 3 months interbank rate LIBOR at about 1% above the Treasury bill rate. Treasury bill rate is the risk-free return which is set by the central bank. The minimum rate of interest that is set by the central bank is called the Treasury bill rate, because that's the rate at which the state bank issues Treasury bills, or central bank issues their Treasury bills. So when they give loan to each other, that is the banks, so they give if it is for short term, they give it for 1% above that Treasury bill rate. And if there's a long term, for example 6 months to a year, then it starts to increase by 2%. If it's more than that, then it will turn 3%. The longer the loan is obtained between the banks, the more the interest it has to pay, as we have just learned above in the relationship between risk and return topic. Then we got a bank interns lend at a rate higher than the LIBOR. It's obvious that it will keep a profit margin for that. If the bank is borrowing from another bank and lending it to a customer, it means that the cost of borrowing has increased for it, and now it will charge. If example, the central bank minimum rate is 6%, the bank will has borrowed the fund for lending purposes to the customer. Now that bank has offered them that the return which they require will be 7%. That's 1% above the risk-free rate. And in turn, when the bank is giving the funds to the company, it will give it on the rate, for example 8 to 10%, to keep its margin of the profit. Then we've got the risk and return trade-off. There is a trade-off between risk and return. Investors in a riskier asset expect to be compensated for the risk. In case of ordinary shares, investors hope to achieve their return in the form of an increase in the share price, as well as from dividends. Main forms of investments are listed below and according in ascending order of the risk. Now, government bonds or treasury bills are least risky. There is a very minute chance of governments to actually get defaulted. It's not a limited liability company that defaults that easily. It's a government we are talking about. So their borrowings are considered as risk-free, and that's the reason why the yield on these you can say assets or instruments is not that much high. You get around 5 to 6%, for example. Then we've got company bonds. Now here the risk is a bit higher than the government bonds, so the investor expects to be compensated for the additional risk exposure. They will normally issue bonds at a rate of around 8 to 10%. It's just an example I'm talking about. It could be more or less depending upon the risk profile of the company and the market scenario, overall economic scenario of the stock exchanges. Then we got preference shares. Again, they are more riskier. Unlike debt, unlike debt, they are not backed by the security. Debt can only be issued if there is a security behind it. So preference shares are not backed by securities, but the rate of return of the preference shares is fixed irrespective of company whether does good or bad. Debt holders and preference shareholders will always be compensated when it comes to returns. Then we have got the ordinary shares. It's on complete discretion of the company how much dividend they want to distribute. So they are the most on the risk exposure profile. The best way to understand this topic is from another perspective, and that is if a company goes liquidated, the corporate bondholders will be the first in line to get their payments, that is the principal and the interest. Then the preference shareholders will get the payments, and if there's something is left, then will be distributed among the ordinary shareholders to compensate them for the investments they have lost. Then we have a reverse yield gap and up. Yeah. Then we have reverse yield gap. Now, due to the lower risk than equity debt, yields has to be lower than equity yields. However, yields on shares are lower than on lower risk debt. The situation is known as reverse yield gap, which occurs because the shareholders may be willing to accept lower returns now to make capital gains in future. Now, one of the phenomenon if you have ever traded or if you ever had an exposure to the stocks or shares, you will see that the return sometimes which the shares generate or the dividend that the company declared is way less than the risk-free security, that is T-bills, because of the current poor performance, or it could be a number of factors. So what's happening over here is that still the equity holders will continue to hold the equity and provide the finance if they see that the company is giving us less dividend now, so that they can fund those projects that will give us more dividend later. So and that is reflected in its share price. Share price is basically the confidence market have on a company on its future prospects. The more they expect that the company will boom in the future, the more the share price of that share increases in the stocks. So the phenomenon that you get less dividend now and the dividends don't cover the risk-free rate as well on the equity share that you have invested, despite the fact that the equity shares are more riskier, is because you will be compensated for that later when the share price or it has already starts to increase in the stocks, because if that's the phenomena, then even on the low dividends the company share price continues to increase because of the investors' perspectives or confidence in that company. That's called reverse yield gap. Then we've got interest rates and shareholders required rate of return. An increase in shareholders required rate of return due to increase in general level of interest rates will lead to fall in market value of shares. Now, interest rates they have an impact on all sorts of investors, including the equity investors. If the interest rate starts to increase, I'm talking about the basic interest rate set by the central bank. It starts to increase. The expectation of the shareholders will also start to increase because they have invested in a more riskier instrument, more riskier equity instrument, so they are required to be compensated for the extra risk which they have taken, and that's why the company has to pay more in terms of dividend to them to keep them satisfied and keep their money invested. Otherwise they start to put their shares on the stock market in a sell column, and as a result, the more the shares appear on the stock exchange screen and there are least buyers, that is, the buyers are not confident whether the company can pay that much dividend, so the share price starts to fall. Simple mechanism of demand and supply. Then we have money market instruments. Now, money market instruments are traded over the counter between institutional investors. They include interest-bearing instruments, discount instruments, and derivatives, and can be either negotiable or non-negotiable. Now, money market instruments basically are traded between the financial institutions, and it can also be traded between the investors as well. Now the thing over here is that they can either be negotiable or non-negotiable. It's best to have to invest in instrument which you can sell and buy easily in the market. So the tradable instruments are most in the, are most popular among the investors. Then we have got the first money market instrument, that is money market deposit. Now, money market deposits are very short-term loans between banks and depositors. These deposits can either be fixed deposit, where the rate of interest rates and maturity dates are agreed at the time of the transaction, or call deposit, where the interest rate is variable and the deposit can be terminated if notice is given. Now, money market deposits are basically a short-term deposit in which you go to the bank, deposit the fund. For example, $500,000 you have invested in a bank, and now what bank does is that give you an instrument, that's money market deposit certificate, on which it's written that you will get the return of this percentage on this whole amount, for example 10%. So the amount which you deposit now, that is $500,000, will be after 3 months you take the bank, the amount which you will take from the bank will be $550,000. Then we've got one more thing in this area as well. We've got a call deposit, where the interest is variable and the deposit can be terminated if notice is given. Here what happens over here, that instead of fixed term deposit, the depositor will keep the fund in the bank and obtain a return over it. It doesn't have to be, in this case, the return is not fixed like the fixed term deposit, and the depositor can withdraw the fund anytime and of any amount. The return will only be given on the amount which is held by the bank on that particular date. They have a computation mechanism for it. Then we got certificate of deposit. Now, a certificate of deposit, or CD, is the certificate or receipt for funds deposited at a bank for a specified term and paying interest at a specified rate. It's simple deposit, unlike fixed term deposit. Difference between certificate of deposit and money market deposit is that money market deposits can be tradable and non-tradable depending upon the terms and conditions which you want, where certificate of deposit are mostly not tradable. Here you get a CD or receipt for the funds deposited at a bank or other financial institution for a specified term and paying interest, and the interest rate is fixed for that specified duration. irrespective whether the central bank increases the interest rate or decreases the interest rate. It's obvious that if the central bank decreases the interest rate, you will get your interest rate will still be high, so you will benefit from it. However, if the central bank increases the interest rates, the return from the investments will start to incur a loss. Then we have got repos. A repurchase agreement is an agreement between two counterparties under which one counterparty agrees to sell a financial instrument to the other on an agreed date for an agreed price, and simultaneously agrees to buy back the instrument from the counterparty at a later date for an agreed higher price. Here what happens is that one party goes to another party, for example a company going to the other company or a bank, and what it does is starts to sell its asset, financial instrument. For example, it has got shares on Facebook, and now it wants to sell it and get the liquid resources. However, it does not completely want to lose the shares, it wants to have them back. Now this is a strange phenomena where you want the shares to be kept with you, at the same time you want the liquidity out of it. So what they do, they get a repo agreement, repurchase agreement, in which they sell the instrument to other bank or company at a rate and get the funds which they require, and when they will get the funds back from the operations which they do, they will return the funds to the bank again to obtain the shares which they have given to them. Obviously, this time when they buy it, they will always be at a higher price, because that's set in the agreement on day one, that they are selling the instruments right now at a rate, and they will repurchase those shares at a future specific date on that particular specific amount from the bank. So everything is arranged on day one, and markets do not have anything to say over here. Irrespective of share price goes up or down, the company will have to pay the amount which is written on the contract to obtain those shares back. Then we've got a reverse repurchase agreement. A reverse repo agreement is for the purchase of an instrument with simultaneous agreements to resell the instrument for an agreed future date and an agreed price. It's basically the mirror image of repo. From a company's perspective, in the last area, from a company's perspective, I had made a repurchase agreement. From a bank's perspective, it is a reverse repurchase agreement. That is, the bank is willing to purchase the instrument with a simultaneous agreement to resell those instruments at a later date on an amount above the rate at which it has purchased. That's how bank has made the profit. Then we've got Treasury Bills, a debt instrument issued by the governments only, with maturities ranging from 1 month to 1 year. Most are issued with maturity of 91 days. It's simple as that. Their interest is set by the central banks. That's the risk-free security which we talked about. Then we've got commercial papers. It's a short-term unsecured debt with corporate maturity of up to 270 days. However, it mainly ranges between 3 months to 6 months, that is 30 to 60 days. Commercial paper can only be issued by the large organization with good credit ratings. There's a formula given over here for its computation. That is, yield on commercial paper is equals to number of days in the year, that is 360 or 365, provided what's the norm. Then days held, the amount that is held. Then you got the selling price less purchase price divided by purchase price, and you will get the yield on commercial paper. Then we've got the banker acceptance. Now, banker acceptance is the most commonly used services offered by the bank. Perhaps you have used it a number of times. It's the basic. If you have ever went to the bank for a pay order to be made, so that's a kind of a banker's acceptance. If you ever opened an LC, that is letter of credit, that's the kind of banker's acceptance. Here what happens is the bank, you go to the bank, you get firstly you get in the transaction that I will be paying, for example, $100,000 for the goods being delivered to me. For example, I'm importing something, so from the goods to be delivered in UK from USA, I'll be paying $100,000. Now here, neither parties knows each other. It could be that he will pay and the goods never arrive. So the risk is eliminated by involving a bank. Firstly, what he or she would do is get the agreement done. When the agreement is done, he or she would go to the bank, draw a banker's check or LC in the name of the exporter that is on the other side of the ocean, that's on America. Now this amount is not paid. The exporter will coordinate with its bank, and that instrument details are sent to the exporter. It will show those details and the bank acknowledges it, which means that if the goods arrive on the ports of Britain, the importer amount which it has fixed in the form of LC will be automatically be given to the exporter in the US. So what happens next is that the exporter, when he or she uploads the goods on the ship and the ship leaves the dock, there will be the shipping authorities give him the document, and that document is submitted to its own bank, and that bank will now submit the document along with the details of the LC or banker's check to the bank in UK, and the UK bank, upon receiving, will coordinate with the port authorities if it wants to. Other than that, the point when the goods are loaded onto the ship is the point of exchange actually, and the amount is then given to the exporter. That's the whole phenomenon of a letter of credit. I'll be explaining it again on the later topic when we will be going to the working capital. So the banker's acceptance is a negotiable bills guaranteed by the banks. As I've just told you, a bill of exchange is a short-term debt instrument that is issued by one person on another. Remember, the LC was made not on the name of the importer, but was made on the name of the exporter. When issued, it is in fact you owe me instrument. The bill is then accepted by the drawee, who notifies acceptance by signing the bill. When it becomes promise to pay on IOU, the banker's acceptance derives from the fact that the bank has guaranteed the payment to the holder of the bank's acceptance. That is, bank has accepted the responsibility for the payment. Banks guarantee the payment by the company for a fee. Obviously, when the importer goes to the bank to open an LC, he or she will have to pay a fee to the bank for this services as well, because banks across the world knows each other very well and they are in confidence with each other that the bank will eventually pay their liabilities. Bankers' acceptance are sold for a discounted basis, like T-bills and commercial papers. Then we have got the futures, forward, and options. Now, futures, forward, and options are basically financial instruments. They are not like shares or debt instruments. However, their base can be on either on them. They are derived from the base contracts, which could be debt or equity. Firstly, we will be discussing about currency derivatives. Then we will be moving towards the interest rate derivatives. There are three types of currency derivatives. First, we've got currency futures, which are similar to the forward exchange contracts, except that they are tradable in the market and you can sell and buy them if you want before being matured or before the date of completion. Then we've got currency options. Now here, just like futures, they are tradable. However, option holder has the right to lapse the option. It means that it has no legal obligation to fulfill its commitment at maturity. It can lapse the financial instrument if it's giving too much of a loss. Let's read out. Just like currency future, except for the fact they provide right but not the obligation to buy or sell a currency, which means company can exercise option if it is in benefit of it and let it lapse if giving a loss. To enter into an option contract, a premium needs to be paid, and that's how the option provider earns its benefit. An option which gives the right to buy currency is called a call option, and the option which gives the right to sell currency is a put option. The difference, you need to be familiar with the difference for computation purposes. However, at the F9 or FM standard, it is not the examiner does not require you to compute futures or options. So, however, they are important from an OT perspective. Next thing we have is currency swaps. It involves the exchange of principal and interest in one currency for the same in another currency. Currency swap maturities are negotiable for at least 10 years, making them a very flexible method of foreign exchange. Now, here what happens is that a company takes out a loan in UK currency and a company takes out a loan in US dollar currency in UK. Both the interest loans are, you can say, the same amount or with an exchange rate fluctuation, of course, and of the same duration. What the companies actually do, that if they believe that they need to pay in dollars because the transaction which they have or the contract which they have obtained by using that fund is in dollars, it would be better if it was a US dollar loan, and the company that has taken the US dollar loan believes that it would be better for us to obtain the company had obtained a UK pound loan. So what they do is simply exchange their liabilities, so that they will pay the interest and principal in the US dollar, and they will pay the interest and principal in the UK pound currency. The companies which have obtained the loan in the first place will not be the same depositing the payments or fulfilling their liabilities. Then we've got interest rates derivative. Now, interest rates future is a financial derivative with an interest bearing instrument as an underlying asset. The value of the interest rates futures is directly tied to the interest rates. The loan is taken, firstly the loan is taken in the normal way. That's the mechanism of the interest rate future. Futures is a separate contract either to borrow or lend money. At expiry, the position is closed out, but by reversing the original deal, the only cash flow that rises is the net interest being paid or received. If the contract is giving you a loss, you have to give the loss to the future holder, that is from whom you have bought the contract, and if it's giving you the gain, then the future holder will provide you with the finance. It's basically, firstly, you will just to sum up the things, you obtain a loan and now you fear that after 3 months of maturity of the loan, the interest rates will be high and you have to pay more to the, so in order to hedge that, you take an interest rate future. Now if this gives you the gain, the future will give you the loss. That's how they operate, and as a result your net exposure to the loan or to the fluctuating interest rate becomes zero. Only the differential between the two will have to be managed by the company. So it's a very good option and it exercised mostly around the world, and the best part about it is that it's tradable. So if you believe that it was not worth of engaging in a futures contract, you can sell it in a market as well. Then we have got interest rates. Options or guarantees is an option on forward rate agreement. FRAs, that is the handle over the counter or OTC. A call option is called a borrower's IRG, and a put option is called IRG is called lender's IRG. Decision rule is simple: exercise the option if interest rates have moved adversely, and allow the options to lapse if the interest rate has moved adversely. If the interest rate moves in your favor, you will exercise the option. Just like the future contract, these the interest rate options also work. If the things move in your favor, you exercise the option, and the option provider will give you the benefit. However, if it's giving you a loss, you can simply let it lapse. That's the beauty of the option. However, a strong hefty fees needs to be paid for such arrangement. Most companies that opt for options normally have a big fund to hedge against. Then we've got interest rate swaps. Is an agreement between two parties where one stream of future interest payments is exchanged for another based on the specific principal amount. Interest rate swaps often exchange fixed payments of floating payments. Because they trade over the counter, they are really just contracts set up between two or more parties, and thus can be customized in a number of ways. That's basically the interest rate swap, in which two parties where one stream of future interest payment is exchanged for another based on the specified principal amount. Here the two parties basically exchange the loan just like in currency swap, but there is a very minute difference. Here the currency is the same, but the rates of interest fluctuate. That is, one company has obtained a loan in fixed exchange rate and the other has obtained a loan in floating exchange rate. So what they do is exchange their loan arrangements. Normally the loan is of more or less the same amount. So they exchange their loans liability, and as a result their interest rate exposure is reduced. Thanks for